Welcome back to Real Estate Mindset. We have breaking news developing as mortgage rates and the 10-year are absolutely skyrocketing, with the 10-year sitting almost up 13 basis points, up 12 basis points right now, sitting at 4.329%, again over 4.3%. We have mortgage rates now updated over 7%, once again sitting at 7.05%. And we have information from Redfin that came out saying that we are sitting at a new record high mortgage payment, sitting at $2,721. What I find interesting about that, guys, is that's at an interest rate of 6.87%. So that's not even counting the increased interest rates. Now, today I have good friends of our channel, Melody Wright, her YouTube channel is Melody Wright, with us here to try to explain what impacts that's going to have on the house market. And I have Jack with Nobody Special Finance, here's his YouTube channel, with us today to try to help explain what the heck is going on and why and what's changed all of a sudden. How are you guys doing? Jack, starting with you, how are you doing today, buddy?
I'm doing good, Travis. Thanks for having me on.
My pleasure, sir. And Melody, how are you?
I'm doing well, Travis. Glad to be here.
Always nice to have you, Melody. So I will open this up, guys. First question to Jack, and then second question will go to you, obviously. Melody, is Jack, I did not think personally we were going to, wake up today, Monday, April Fool's Day, and have the 10-year and mortgage rate skyrocket like that. I honestly thought it would slide downward until maybe Thursday and Friday when we have job numbers come out. What happened, Jack?
So it looks like, as far as I can tell, what happened is we had back-to-back manufacturing PMIs came out today. At 9:45 a.m. Eastern time today, we had the S&P Global Manufacturing PMI came out. And then 15 minutes later, the ISM, or the Institute for Supply Management, came out with their manufacturing PMI. And both of those PMIs were actually pretty good now. We've had a little bit of a reversal over these last 3 or 4 months or so, where the manufacturing numbers have started to improve a little bit, ever so slightly, showing expansion in the manufacturing sector. Now, for the better part of a year and a half, we've been deeply negative in the manufacturing sector. So it looks like manufacturing has turned a little bit of a corner. Those numbers are starting to pick up a little bit, but that's not really what sent interest rates surging. What happened was, within both of those reports was some data points about pricing pressures that manufacturers are seeing. And that kind of spooked the market to make them think, we have got a second leg of inflation is just around the corner. Now, back up a little bit, we've had 3 consecutive numbers now where the CPI and the PCE has gone up a little bit. Really, since the start of the year, they haven't been huge increases in inflation, but they have been increases, and this is after a year or so of inflation falling pretty quickly. So the Fed has been, they weren't necessarily dismissive. As a matter of fact, Jerome Powell was really overcompensating in his last FOMC meeting. He actually said 7 or 8 times, I'm not dismissing this inflationary data, right before he dismissed it. So, they were very careful to pay lip service to saying, yeah, we're watching the data very closely, but we think this little blip in inflation of the last 3 months is a never mind thing. We expect it to reverse and resume downward, onward towards a sustainable move towards 2%, all that Fed jargon. But it was this line in particular. I'm going to read you. I have the S&P PMI report in front of me right now. And on page 2 of this report, there's 2 paragraphs in particular that are pretty damning when it comes to an inflation standpoint. They're saying input costs increased sharply, with the rate of inflation ticking up from that seen in February. Higher oil and raw material costs plus increased transportation rates, there's your Red Sea starting to factor in, reportedly added to cost burdens at the end of the first quarter. Meanwhile, the impact of rising labor costs was mentioned as a factor pushing up selling prices at a number of manufacturers. As a result, the rate of output price inflation quickened for the 4th month running to a sharp pace that was the fastest in just under a year. And then there's this quote here. If you bear with me for 1 second here. The upturn is, however, being accompanied by some strengthening of pricing power. Average selling prices charged by producers rose at the fastest pace for 11 months in March as factories passed higher costs on to customers, with the rate of inflation running well above the average recorded prior to the pandemic. Most notable was an especially steep rise in prices charged for consumer goods, which rose at a pace not seen for 16 months, underscoring the likely bumpy path in bringing inflation down to the Fed's 2% target. So those are right out of that S&P Global Manufacturing PMI that came out at 9:45 a.m. Eastern time today. The market did not like that one bit. Interest rates started heading higher, and they haven't really looked back ever since. A few minutes later, we got the ISM Manufacturing PMI, and that said something similar. I won't read you directly from the report there, but basically, higher inflation is coming. We're already seeing it with the producers, with the manufacturers, and they intend to pass that cost on to the consumers, which means higher consumer price inflation is on the horizon here.
Okay. And, so in other words, consumer prices of goods it has went up the first time in 18, I think you said 18 months. For lack of better words, Jack, we have runaway inflation. Interest rates aren't high enough to deal with the money printing that's still going on, the deficit spending. Probably the market's adjusting now, starting to get, maybe there's not going to be a rate cut this year unless there's a recession. Some good stuff there, Jack. Now, Melody, do you have anything you want to add to what Jack was talking about?
No, I think that was a great summary, and I would concur with everything that he said.
Okay. And, next question to you, Melody, is how's a rate surge? Obviously, it's been surging since, I'll arguably say, since quantitative tightening, but since the beginning of the year. How is this surge, right? Sudden change? How does this surge affect the housing market? What are you seeing?
Well, since mid-February, we had started to re-accelerate. But because you and I, we watch this, Travis, religiously, like we watch every move in the 10-year. And we had started to see it kind of softening again. And I think, so I think this is a bit surprising, but what this does to the housing market, the 10-year is a proxy for funding costs across the world. And so with that remaining elevated, that means that funding costs are elevated as well. Additionally, you have the builders who have been, offering those rate buy downs. This is going to compress their margins. And then you have the borrowers out there who are just going to hear that rates are up again. And the fact that, inflation may be rearing its ugly head. And, the narrative will become higher for longer, even though most really don't understand the relationship between mortgage rates and, these benchmark rates. But the bond market has its own ideas of what's happening. As Jack was kind of saying, it's not really, it's impacted by what the Fed is doing, but it's the bond market reacting. And they are saying, okay, right now we think that inflation might be a tad, maybe it's not decelerating as much or as quickly as folks think. And I think this is saying that rate cuts are going to be pushed backward, which impacts the narrative for potential homeowners out there. They're going to hear that and they're going to think it's not a good time. Not to mention, of course, as you know, home prices are just out of control. And so these two things combined with the mortgage rates here higher, because you don't have someone like the Fed buying mortgage-backed securities right now to help, kind of suppress those rates downward. They are going to be higher. And so, this isn't good news for the housing market, no matter which way you look at it.
Well, certainly, Melody, to summarize kind of solid points you were making is demand is getting smashed a little bit more because demand is still a little bit out of control in the form of that consumers still have money to spend. It looks like the market's now anticipating maybe a ratchet up in loose monetary policy or money printing, even though we don't see it in the deficit. Like, what the heck? Like, why are they still spending money? Like 2023 spent the deficit was 1.7 trillion. The deficit in 2019 was 1.4 trillion, and we didn't even go into recession in 2023. Didn't even go into recession. But I like how you mentioned as well that the no purchasing of mortgage-backed securities and the fact that that does not artificially lower interest rates, like what happened during lockdowns where the government is purchasing loans. To the viewers, mortgage-backed security, they're purchasing a loan. Banks have to sell loans. They say a bank has $100 million, they loan $100 million, they go out of business because they got no more money. So they got to take that loan that they just lent, sell it secondary market. Now, Jack, Anything you want to add as far as the surge and what that is doing and what impacts you think that's going to have on the markets? Maybe you could talk about the lag effects and maybe how that will push along these whole mythical, even, right? Maybe it's mythical, like unicorn. Are the lag effects the new unicorn? Can you talk
Now,
about
when
that?
you talk about lag effect, which data point in particular are you referring to? Just want to make
You
sure.
pick, Jack. You go ahead and pick that one, buddy.
All right. Well, first of all, there is one lag effect. I'll get to that in a minute, and I do think that's going to play a role here pretty soon. But let me just say, stepping back, the Fed and their decision to raise or to lower, it's important to keep in mind the Fed only controls the overnight rate, right? They only directly influence the short end of the yield curve. The long end, the bond market drives that. Now, the Fed can influence that because they have a huge portfolio of securities. They can decide to sell those or buy those, and they can influence it one way or another. But for the most part, the Fed only directly controls that overnight rate. So what you're seeing right now is the market is looking at this data that we just got. They're also viewing this in the context of gold at all-time highs here. They're viewing it through the lens of CPIs have been moving higher. We got PCE data on Friday that some analysts said it was encouraging. I looked at the same data. I didn't find it encouraging at all. But the market is saying we expect a second wave of inflation here, and so we're going to start demanding a higher interest rate in order to lock up our money for 10 years. So that's what's going on here right now, and that's independent of what the Fed does with the overnight rate, right? We could see a situation where the Fed is cutting short-term rates and the 10-year keeps moving higher, right? Because people continue to demand a higher interest rate to lock up their money. So the Fed won't control that long end of the yield curve. Now, as far as the lag effect, there is something kind of lurking out there in the inflation data that we haven't seen it yet, and that's the rent. The rent numbers, there is a very pronounced lag effect where, because of the way we measure CPI and the way we measure owner's equivalent rent is the biggest data point in the CPI math, which is where they call up homeowners and they ask them out of the blue, how much would you rent your house for unfurnished without utilities? And most people just kind of spout off an answer that's usually their mortgage payment plus $100 or $200, something like that. So asking rents, what we'll see in Zillow, what we'll see in Redfin, what the actual person who's shopping for a place to live will see, doesn't directly influence CPI and the consumer price index. That's really homeowners and this hypothetical question that they just blindside homeowners with. That does. And there is a very strong lag there because when asking rents go up or down, it doesn't influence how a homeowner answers that question right away. It usually takes about a year and a half. And a lot of people are expecting the owner's equivalent rent statistic, which is the biggest variable in the CPI, to start coming down sharply in the coming months. Now, I've expected that for a while now, and it hasn't happened yet because the rents have stopped going up in most markets. They've started coming down pretty substantially in other markets. But then again, some of the things you've documented on your channel, how they're saying, well, we'll pay the first 3 months of rent for you for free. So really the asking rents, they've come down, but they're hiding that actual sticker price. So it doesn't quite show up yet. So maybe that's having a little bit of an effect. But there is a big downward pressure on the inflation statistics that we haven't seen yet from the rental numbers that isn't showing up. And I think that's why Powell might have seemed a little dismissive of some of the increases in inflation recently, because he's expecting that to show up soon.
And Jack, what if the opposite happens? Talk a little bit, bulls or like Dave Ramsey, specifically, I'll call him out, said rent has gone up always since the birth of Jesus. Says rents have always gone up. So what happens if the data keeps coming out, Jack? And I know it's a lagging indicator, but rent keeps going up. What will the Fed do if rent keeps going up?
Well, the Fed now has to worry about their credibility here because they've been telegraphing these rate cuts for a while. They started telegraphing them late last year. So the Fed still has some egg on their face from transitory a few years ago when they said, yeah, we know there's inflation is going to come, but we don't expect it to go much beyond 2%. How'd that work out for you? And the Fed also, they've still got a little bit of egg on their face from the last time they were doing their quantitative tightening. And Jerome Powell made a few references to this. At the end of 2018, there was some disorderly function in the bond market. We saw a big spike in rates and the Fed had to very abruptly stop their interest rate hikes. And then a few months later, in September of 2019, we had the repo madness event where the Fed had to almost instantly pivot from not QE or from quantitative tightening to, what did they call it, not QE. So the Fed has had a couple of bad calls in the last few years. And the most notable one, of course, was transitory.
Yeah.
So now they've been sitting here telegraphing for several months that rate cuts are coming. And now the inflation data is not playing nice. It's not doing what they want it to do. So the Fed has two options. They can stay this course that they've set us on, which, is what I think the stock market wants to see. The stock market loves certainty. And Jerome said the rate cuts are coming, or he didn't say it specifically. He said it may be appropriate to adjust our policy range, all that Fed speak. He's basically telegraphed these cuts. If these cuts don't materialize, he's lost more credibility, and the Fed's credibility is already damaged. And that's so important because, I don't think the Fed has very much credibility. I'm assuming you two don't either, but the average person on the street or the casual investor still thinks they have this under control. And I don't think they do. And, we're sitting here having this conversation with unemployment sitting at 3.9%, which is a pretty good number. It's rising, but it's still pretty low. We have the luxury of even having this conversation because people aren't losing their jobs en masse. I'm not sure that's going to keep up very long here. So the Fed's kind of painted into a corner. I think they have to make that cut still. And if you cut with stocks that are already at bubble valuations, with asset prices already at all-time highs, you're going to cause inflation to go higher. And I think the reason why we're seeing a thing like gold at an all-time high, even though the stock market's at an all-time high too, those don't usually occupy the same space, is the market sees the data sucks, and the market thinks the Fed's going to cut anyway. So they know that inflation is going to come back, and gold typically does very well before inflation shows up.
It seems like they just replaced quantitative easing with government deficit spending. They're just calling quantitative easing something else now. They're just not giving it to the consumers. Melody, if I may ask, in your infinite wisdom, which is way more than mine, for some reason, I just started thinking of the Never-Ending Story. Have you guys seen that? Have you seen that, Melody? Never-Ending Story?
Yeah.
Great
Been a while,
movie.
but yes.
It's been to the viewers. I'm going to just real quick. Okay, this gets scary. Watch 1980s family movies. You're welcome. You will remember where we came from. Melody, are the rates high enough? We have government deficit spending out of control. Maybe that's the new QE. Are rates high enough, do you think, Melody?
Yeah, to me, I focus a lot on the consumer. And at this point, so we had the K-shaped recovery. We're in the K-shaped decline. And we're saying kind of, those rate hikes have impact on those upper echelon asset holders. I'm absolutely, you're seeing it, it's happening. And then, from a high price perspective, the bottom of the K is completely under stress. They're going to food banks. They're housing insecure. You've got FHA delinquency at 10%. So, what's happening, I think, though, as things like increases in taxes and insurance, you're starting to creep up the K. So you're kind of creeping down the K at the same time that you're kind of creeping up. And so I think that more and more folks are getting impacted. So I honestly am one of the few who believe that, it doesn't matter what the Fed has done. The train has left the station. I've said that too many times, I'm sure. But prime borrowers, this is simply not sustainable. So no matter what happens, we are in for significant consumer stress in the future, unless we have direct fiscal stimulus again, for whatever reason. And so, whatever, can they hurt or harm things? Absolutely. Can they help things? I don't think so much anymore, but that's, of course, my opinion.
So in other words, the rates are certainly high enough for normal consumers. I would say the 70% of consumers that are living paycheck to paycheck, right? Like the rates are high enough for them, but maybe they're not high enough for the elite, Melody. Maybe they're not high enough for the deficit spending. Have you looked and compared, and I know it's hard to do that because inflation, obviously, and all these things are changing. But have you seen the differences of deficit spending compared to the GFC and how much bigger that government
Oh, absolutely. We're
subsidy,
in a
government help
wartime
bubble.
deficit spending. We're not in a war. I mean, this is
Yeah.
unbelievable, but to me, but here, I just think it's kind of like they're on a bike, but it's just running. I mean, there's running out of runway, meaning that, you can keep injecting that government money. You can keep deficit spending, but you get such a lower productivity on that amount of money. I think Dr. Lacey Hunt, several have done deep studies about how unproductive this debt spending is. Like, I can't remember what it is. You may know, Jack, for like, used to, if you had debt spending, you get X amount of, productive GDP, and that has decreased exponentially. And so, I just think that the efficacy or the effectiveness of this just starts to lose steam. And I think we've actually been seeing that since, 2007. I mean, we honestly have just been seeing, steam go out of GDP. And you're just going to continue to see that until it really does come to a crisis moment. And in my opinion, which, typically the way these things get worked out are either through war or financial repression. And I feel like we have been in a world of financial repression since 2008.
And, Jack, just kind of rounding us out here, would you argue, Jack, as a result of deficit spending, maybe manipulation of data, maybe because they're calculating GDP differently, unemployment differently, would you say that we are already in recession?
So textbook, no, because as far as, the math for GDP, the GDP is consumption plus investment plus government spending plus the trade balance. Government spending is part of GDP. And so as investment has not done well, we have a deeply negative trade balance. Obviously, in this country, we import way more than we export. Consumption's actually holding pretty steady here, but the government spending has increased dramatically. So yes, government spending is a part of GDP, the textbook definition. So that is expanding, and that is enough to keep GDP positive. And we've also got things like government spending is increasing the investment side of things. We've had a lot of manufacturing construction in the US in the last year or so because we're building electric vehicle factories and we're building chip factories that are all being paid for, at least partially, by government grants. So the G is also pushing the I in the GDP equation a little bit higher. The investment spending is going up because you've got Micron building a big chip factory in New York. You've got Intel building a big factory in, I think, Arizona and Texas. But government spending is partially funding that. That wouldn't be there without the government spending. So no, we're not in a recession, at least not textbook recession. And, I know the economists love to argue nuance of textbook and everything. But I would also add that the consumption is being a little artificially inflated here too, because we've got the banks are extending credit for whatever reason to people who probably won't pay it back. Credit cards are on the rise. Buy now, pay later is on the rise. And I think that's partially being inflated a little bit by the fact that about 40% of student loan borrowers still aren't making any payments and the government isn't doing anything to them. The government has actually made it illegal to report that to the credit bureaus if you're not paying student loans. So you've got money that would be going to pay student loan payments and it's instead going to buy crap. And so it's artificially inflating the consumption figures too. So there's all these twisted ways that they can manipulate the data that maybe it's still within the confines of textbook GDP growth, but it's certainly not sustainable. It's certainly not healthy or good in any way. And, there's one other thing I want to point out here is that we've had a lot of drawdown in the reverse repos. That's money that was printed in 2020 that never ended circulation. We've had about $1.5 trillion has come out of the reverse repo since like May of last year, March of last year. We've had 2 quarters in a row where the quarterly refunding announcements have been lower than expected. Basically, the Treasury has been issuing fewer new treasuries, issuing less new Treasury supply because they've been spending down the money that was in the Treasury general account. That's not sustainable. That's something that's going to reverse very soon. So there's been a lot of these Band-Aid things that have been going on, kind of a shell game with the liquidity that have all put downward pressure on interest rates. And were it not for those things, interest rates would be on the 10-year would be pushing closer to 5%, probably higher than 5% right now. So there's a lot of this data manipulation going on. It's not outright legal. It's not fraudulent, but it is manipulative. It is misleading. And if you take that stuff away, that's the rug that's hiding all the crap that they've swept under it.
Yeah, maybe we're not in a technical recession, but I find it very interesting, Jack, when government deficit spending again was 1.7 trillion in 2023, but the GDP growth, year over year GDP growth, was 1.6 trillion, which means you could kind of argue that all of the deficit spending was a reason why there was GDP growth, but we will argue that a different day. I'm not an economist. I'm just pointing out the numbers. Melody, if you can, I'm rounding us out here. It's our last question. How can the everyday normal consumer deal with the interest rates going up like this in a way to where they can win, they can get ahead of the inflation? What can consumers do?
Yeah, that's a really tough question. I can only speak about what I really have done. And, I had to make a lot of just seeing what was coming, seeing what was ahead, a lot of difficult decisions about the way that I'm spending my money, consumption 70% of GDP. And so every dollar we spend is actually a vote, in my opinion, because I feel like kind of it's been our voting in the past several elections has seen fairly ineffective, but I think that we speak with our dollars. And this is something that I think many forget, that they have this agency. And so what I would just encourage everyone to do is kind of think about that. What every dollar you spend, what are you supporting? And when you spend it on, when you go out and you purchase a home at prices like this and carrying costs like this, you're supporting an unsustainable reality for your children and the future. And so to me, this is about do whatever you can. I mean, one of Jack's sayings is my favorite, which is live small. It's do whatever you can to free yourself from debt slavery, whatever that is. And, that can be just small decisions every day, not going to Starbucks, not, going out to eat every day, cooking at home. One thing we're doing where I'm living on a 13-acre farm. We're going to be gardening. We're starting that. We're tilling this week. And so these are the kinds of things that you can do to kind of combat inflation, but none of them are going to seem particularly sexy or even sometimes comfortable. But, what I would just have somebody do, just try using your debit card for a week. Like, don't use any credit card. And I know you might forego some of your points, blah, 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 but how much those points really matter. But just do it for a week or 2 weeks. Don't use your credit cards. Just do it with your debit card and see if that changes the way that you spend money. Just see. And if it does, then you probably need to change your habits.
Spending habits. I preach about it all the time. So much starts with spending habits, how much you make, how much you can save, your future investment opportunities. Spending habits are so important. You know what? And I honestly, Melody, I think 5% back on my T-bill and chills is sexy. I think we forgot what sexy is, to be honest with you. I think I think millennials don't know what sexy is. I know what it is. And to me, 5%, that's a sexy return.
That is pretty sexy, for sure.
It is. I mean, it's risk-free. It's risk-free. Jack, can you end us out here? Same question to you. How can the consumer deal with the higher interest rates effectively?
Well, first of all, me, I love data, Travis, and the birth rate data supports your theory that the millennials and the Gen Zers don't know what sexy is. So I'm just going to go ahead and throw that out there, that the numbers back that up. All right. Now, last thing I'm going to throw in for people, help them win, as you like to say. All right. Data was just out. I forget the original source of the data, but I read the article over the weekend. It is now officially cheaper to rent than own in all 50 states. Yeah. All right. So no FOMO. Don't chase these prices. It's cheaper to rent. All right. So put that difference in your pocket. All right. Bite the bullet. Live in somebody else's house for cheaper for now, but pay yourself the difference. Put it in that 5.4% you can still get in a 1-month T-bill for zero risk. And then wait for the prices to come down. We hear all this stuff about Blackstone's buying up all the single family homes and all the private equities doing it. it's cheaper to rent than it is to own. Do you know what that means? That means all of these outfits are going to lose money on these deals. That means that none of these rentals are cash flowing for them. So as long as the government doesn't step in and bail out Blackstone when they lose $50 billion on these single family rentals, then all those homes are going to hit the market for dirt cheap, and you'll be able to buy them from them for less than they paid for it. So sit back and wait, pay yourself while you're waiting. The government wants to be irresponsibly financially with their 5.4% borrowing costs and their $1 trillion deficits. You might as well be the one getting paid for that, because you're going to pay for it on the back end in the form of taxes and inflation anyway. Might as well collect the 5.4%.
Well said. You guys are absolutely wonderful people. To my viewers, show them love. Go to their channels. I love you guys. Thank you for spending time with my viewers and sharing your insights. I find them so valuable personally. I know my viewers will as well. But again, you guys, go to their channel, like this video. And other than that, if you guys are out there investing in real estate, we wish you luck and we hope you win.